Okay, so we start now. Yes or no? Okay. So today we are going to start with the new chapter. Name of the chapter is Capital Gains. So in the examination, the weightage is approximately 8 to 10 marks. Okay. Another big chapter and very interesting also. Capital gain chapter. So 5 heads of income. This is the 4th head of your income. Okay. Now in the capital gains, what are we all supposed to do? Simple. We have divided this entire chapter into how many parts? 5 parts again. Okay. So one by one, each part we are going to complete and the chapter will be over. Okay. So section 45. Which section, sir? Section 45 to 55A. These many sections we are supposed to do. Okay, no? These many sections we are supposed to do. We have divided these sections into 5 parts. First one is basics. Second one is specific charge. Third one is special aspects. Then exemptions. And then tax rates on capital gains, which you already know also, I guess. What is the tax rate on long-term capital gain? 12.5%. What is the capital gain on short-term capital gain? 20%. Yes or no? But in this chapter, the tax rates will be discussed in details. Okay, no? So long-term capital gain, short-term capital gain, tax rates, what are the tax rates, what important things you should keep in mind while applying the tax rates on your long-term capital gains. All those things we are going to discuss in detail. Okay. So now the first part of this chapter is basics. After doing this part now, you will be in a position to calculate the capital gains in simple cases. Simple cases means normally how to calculate your capital gain. Okay. But after that, few important things will be there. Like there is a specific charge also under this head. So specific charge will be your second part. Like I told you in PGBP, there are 2 types of charge: general charge and specific charge. Specific charge will tell you about those incomes which are taxable only under PGBP head. Just like that, there is a specific charge under capital gains also. Capital gains, specific charge will tell you the profits or gains specifically taxable under the head capital gains. So that is given in specific charge. Then there will be some special areas, special situations. In those situations, how are you going to calculate your capital gain? That will be your special aspects. And there are certain capital gains which are exempt under section 54 to 54 GB. Okay, no? These exemptions are there, but all the sections are not supposed to be done by you. All the exemptions are not supposed to be done by you. Few exemptions are there in your CA intermediate syllabus and few exemptions are in final CA. Okay, no? Now, exemptions which you are going to do, these are those capital gains which are exempt. So when the capital gain will be exempt, how their exemption will be calculated. Okay, no? So if you do this entire part and you leave exemptions and you are going for the exam, understand that if capital gain question is there, majority of the times they will ask you exemptions also in that capital gain question. So not doing this thing, meaning you are trying to lose your marks. So your marks will be lost because in the main question of capital gain, without exemption, normally they don't frame the questions. Okay, no? So now one by one we'll start the different parts. The first part was basics. In basics now, very first section 45. It is a charging section. Charging section will tell you which income will be taxable under the head capital gain. So how many types of charge are there? two types of charge. One, general, and second one is specific charge. Read about the general charge. Okay, no? General charge is given in section 45(1). Read it. What section 45(1) says? Section 45(1) says that any profit and gain arising on transfer of that profit and gain will be chargeable under this head. Sir, profits and gains are chargeable under PGBP head, no? But that is a profit or gain arising from any business or profession carried on by the associate any time during the previous year. But this is a profit or gain which will be arising on transfer of your capital asset. So during the previous year, if your capital asset is transferred, on the transfer of your capital asset, whatever profit or gain will be there, that profit or gain will be taxable under the head capital gains. Okay, no? Now, if you will see, your profits and gains are taxable under this head. Under this head. When it will be taxable? It will be taxable during the in which such capital asset is transferred. Meaning, you have to check that in which year the capital asset is transferred. That will be the year in which your capital gain will be taxable. So the year of transfer, is the year of taxability. Year of transfer is the year of taxability. Okay. Sometimes in some situations, the capital gain will not be taxable in the year of transfer. It will be taxable in some other year also. But those situations we are going to do in specific charge. Okay, no? So first of all, profit or gain should arise on transfer of a capital asset. Then that profit or gain will be treated as your income, which will be taxable under this head. But it will be taxable in which year? In the year in which the capital asset is transferred. Sure, sir? Okay. Now, there are certain specific type of profit or gain. Profit or gain arising at the time of receipt of insurance claim. Profit or gain arising on conversion of capital asset into stock in trade. Profit or gain arising on compulsory acquisition of a capital asset under any law. So there are certain specific type of profits or gain arising at the time of some special situations. So those profits or gains will also be taxable under the head capital gain only. That is given in your specific charge. So there are specific charge also. Section 45(1)(a), section 45(2), section 45(5). Other than this, 45(3) is also there, 45(4) is also there, 45(5)(a) is also there. So those sections are not there in your syllabus, so we are not going to touch them. Only these specific charge are there in your syllabus. 45(1)(a), 45(2), and 45(5). These three specific charge, and along with that we are going to do section 46 and 46(a). So this entire part will be covered. This entire part will be covered in the second part of your chapter. Okay, no? Specific charge will be covered in the second part of your chapter. Right now we are going to focus only on first part, basics. And in basics we are going to focus on first, what? General charge. So as per the general charge, tell me, as per the general charge, what you come to know? That see, sir, in this head, no, I have to charge what? Profit and gain only, sir. But that profit or gain should arise on transfer of a capital asset, sir. So what is the meaning of capital asset? First, you'll have to understand that. What is the meaning of transfer? Then you'll have to understand that also. Once you'll understand the meaning of capital asset and transfer, only then we'll learn that how to calculate the capital gains. Okay, no? Now, if there is a capital asset and there is a transfer, only then the profit or gain will be computed. No need to compute the profit or gain if there is no capital asset or if there is no transfer. Capital asset is there, transfer is also there, then only you are supposed to calculate what? Profit or gain. But if capital asset is not there, transfer is there, then no need to compute profit or gain. Sir, what if transfer is there, but the item which is getting transferred is not a capital asset? Then no need to calculate. Yes or no? But what if, sir, capital asset is there, transfer is not taking place? Then no capital asset, no transfer, no profit or gain. So both the things are required. First one, capital asset should be there. Second one, transfer should be there. So you should be first knowing the meaning of these two terms. What is capital asset? What is transfer? Yes or no? So first of all, let's go and check what is the meaning of capital asset. Okay. Capital asset means A, B and C. Capital asset means A, B and C. However, the term capital asset does not include A, B, C, D, E and F. 6 points are there. These are not treated as capital asset. So your definition of capital asset. So first of all, number one, you should be having a capital asset. Okay, no? So in the definition of capital asset is defined under section 2 subsection 14. In the definition of capital asset, two things are given. Number one, capital asset means, and capital asset does not include, meaning this is your capital asset, this is your capital asset, and this is also your capital asset. A, B, C, D, E and F. All these 6 items are not treated as your capital asset. So one by one, first of all tell me, capital asset means, it means property or asset of any kind. What did I say? Property or asset of any kind. Any kind means what? Any kind means any type of your asset or property will be treated as capital asset. Any type means whether the asset is tangible or intangible, movable or immovable, fixed or circulating, whether used for business or not, will not make any difference. Any type of asset you are having, any type of property you are having, that will be treated as what? Capital asset. In short, all assets are capital assets. All properties are capital asset. Sir, tangible asset is there, capital asset. Intangible asset, capital asset. Movable asset, capital asset. Immobile asset, capital asset. Fixed, circulating, capital asset. Whether used in business, capital asset. Not used in business, capital asset. So in short, the definition is so wide that it covers all the assets in the definition of capital asset. Yes or no? Now, two things are specifically considered as your capital asset. Number one, shares and securities held by FIIs. You know FIIs, meaning of FIIs? What is FII? Huh? Foreign institutional investor. Okay, so what are foreign institutional investors? Tell me fast. Who? What is foreign institutional investor? First one, investor is there. From India or from foreign? So foreign investor, but institutional investor, meaning what? Big financial institutions of outside India, like big banks, mutual funds, insurance companies, Not from India, from outside India. Big fund houses. They are what? Institutions. They are what? Institutions. So any institutional investor from outside India is known as what? Foreign institutional investor. Okay, no? Now tell me, what is the main business of this foreign institutional investors? They invest in the shares and securities of different companies in different countries. Different companies in different countries. So for example, some institutional investors from Canada, some institutional investors from US, some institutional investors from Germany. Okay, no? What is their main business? Their main business is to invest the huge funds, huge amounts which they are having in their hands. Just imagine, there are big banks, insurance companies, fund houses, mutual funds of foreign country. How much money will they have? They will have huge amount of monies. And all that money, what they do? They invest in shares and securities of different companies in different countries. So they will invest in the shares and securities. They will buy the shares and securities at correct time, at cheaper values. And whenever the values will grow, they are going to sell them and earn their profits. So this way they do their business. This way they earn their profits. What they will do? They will buy shares and securities of various companies in different countries. And all those shares and securities they will buy at correct time, at very cheap prices, and at profits they will sell them. At higher price they will sell them and they will earn the profits. So they are in that business only. So their business itself is to buy and sell what? Shares and securities. Their business is to buy and sell the securities in huge quantities in different countries. Yes or no? So tell me, the shares and securities which they are buying and selling, that is their business. So the shares and securities will be their asset, will be their stock in trade, will be there. And if they buy and sell their stock in trade, what type of income will arise? Buying and selling of stock in trade will give you what type of income? PGBP income. Simple, no? So if they sell the shares and securities, what type of income will arise? Shares and securities of any Indian company. They will sell, they will buy. What type of income will arise? PGBP income. And now since it is their PGBP income, it will be taxable at what rate? Normal rates, because there is no specific rate on business income. I have already taught you salary head, house property head, PGBP head. Yes or no? Under any of the heads, did I tell you that your salary will be taxable at this specific rate? Your house property will be taxable at this specific rate. Your PGBP income will be taxable at this specific rate. There is no specific rate. So these incomes are taxable at what rates? Normal rates. Which rates? And the normal rates applicable to any foreign company is what? 35%. Earlier it was 40%. Earlier it was, last year only they have brought down this rate to 35%. Plus surcharge 2% or 5% depending on the total income. If the total income is more than 1 crore but up to 10 crores, then the surcharge will be 2%. If the total income is more than 10 crores, then the surcharge will be 5%. On top of that, 4% health and education cess. On top of that, whenever they will take their profits to their country, that time the conversion charges, etc. So effectively, the tax which they were paying on their profits by selling the shares and securities of Indian companies, effectively that tax used to be 50%. So on profit of 100 rupees, give 50 rupees to the government of India in the form of taxes and conversion charges, etc., and take remaining 50% to your country. Tell me, if you are a foreign institutional investor, you have invested in the shares and securities of Indian companies and you have earned a profit of rupees 100. If 50 rupees profit is kept by the government of India, will you be interested in buying the shares and securities of Indian company? Why? Because bloody I am earning 100 rupees as profit. 50 rupees profit is kept by your government only. Such a huge tax which you are charging to us, okay. Forget about your country. We are not going to come to your country to invest money in the shares and securities of your companies. They did not, they used to not invest in Indian companies' shares and securities. Why? Because the tax rates were very high. Why the tax was higher? Because the shares and securities are held by them as their stock in trade. They are in the business of buying and selling the shares and securities of various companies in different countries, including Indian companies, including India. So whatever shares and securities of Indian companies, they will buy and sell. On that, they were liable to pay what? Tax at normal rates. Because the shares and securities are held by them as stock in trade. And whenever they are going to sell their stock in trade, the resulting profits are going to be charged under the head PGBP, and that was charged at what rate? Normal rates. And because of the normal rates applicable on that profit or gain, what used to happen? They used to pay higher taxes. And as a result of that, they were not showing interest in the capital markets in India. They were not investing in foreign currency in the capital markets in India. They were not buying the shares and securities of Indian companies. Understanding? So government was inviting them, please come to India, buy the shares and securities of Indian companies. They were saying, no, we don't want to come to your country. We don't want to buy the shares and securities of your companies. Why? Because the moment we'll buy and the moment we'll sell, you'll consider our income as PGBP income and you're going to charge tax at normal rates. So this much huge taxes we don't want to pay. It is better to invest in China. It is better to invest in Bangladesh. It is better to invest in Vietnam. So those foreign institutional investors having huge sums of foreign currencies used to invest in other countries. So that way the foreign currency inflow was not coming to India. And for any economy, for any country, the foreign currency inflow, foreign exchange inflow is very important for the growth of that economy. And which was not happening. Our foreign currency reserves were shrinking. Foreign currency was not flowing inside the country. Because these institutions having huge amounts of foreign currencies were not showing interest in Indian shares and securities. So to attract them, come to India, invest in the shares and securities of Indian company. So when they'll come to India, they'll invest in the shares and securities of Indian company. They will bring their foreign currency. So they are going to invest in the foreign currency. And till the time they are invested in our country, their foreign currency will also be there in our country. So that will increase the reserves, foreign currency reserves in India. And ultimately that is going to help the economy to grow. Our economy will be strong. So what to do to attract them so that they come and invest in foreign currency? What to do? Their income should not be taxed at normal rates, which is very high. So their income should be taxed at a special rate, which is very low. So special concessional rate of tax we will offer on their profits and gains. But for that, the profits or gains should not be taxed under the head PGBP. For that, consider their shares and securities as their capital asset. Instead of Stock in trade. So their stock in trade, meaning their shares and securities under the Indian Income Tax Act will not be treated as stock in trade, will be treated as capital asset. Now any profit or gain arising on transfer of these shares and securities will be taxable under the head PGBP? No, will be taxable under the head capital gains as their capital gain income. And on this capital gain income, a special concessional rate of tax is offered to them, which is very, very low as compared to the normal tax rate. So this gave them motivation to come to India and to invest in the shares and securities of Indian companies. Yes or no? So what was the reason for making this asset a capital asset? Did you come to know? Hello? But you have to remember, any shares or securities are held by FIIs as per the SEBI regulations of Indian companies will be treated as capital asset and will not be treated as stock in trade. Will be treated as what? Capital asset. Specifically under the definition of capital asset, this asset is also treated, covered as a capital asset. Will you remember? Other than this, all assets and properties are what? Capital asset. But any shares or securities held by FIIs will also be treated as capital asset. Now this point number C, no, is not relevant for you at CA intermediate level. Okay, no? This you are going to learn in detail in CA final. Okay. Now see, point number C. What does it say? Point number C. Tell me. What is the full form of ULIP? Have you heard about unit linked insurance plans? Unit linked insurance plans. You call it ULIPs in short. Yes or no? So, one insurance plan is there. That insurance plan gives you what? The benefit of life insurance. That is a normal insurance plan. So if you buy that insurance plan, what will happen? You will get life insurance. That's it. Understanding? Keep it separate. Now if you buy units, units of mutual fund, units of UTI, yes or no? These units are your assets. So you can go and buy the units of any mutual fund, UTI. If you'll put your money, if you invest your money in units, the value of the units will grow. And after some time, when you will sell your units, you'll earn profits. So whenever you sell units, gain will arise. What will arise? Tell me. Gain will arise. And that gain is taxable under the head capital gain. So units can be units of UTI, units can be units of mutual fund. What is units? Units is nothing but shares only. Shares. So in the company when you invest, the company will give you shares and you become a shareholder. And if in UTI or in mutual fund you invest your money, okay, so that UTI or a mutual fund will give you what? Units. And you become a unit holder. On shares you get what? Dividend. So on units also you get dividend. Shares value will go up and investment in the shares will go up. You'll sell, you'll get profits. That will be your capital gain. And just like that, if you will sell the units for a higher price as compared to the price at which you have acquired them, profit will arise. That profit will be your capital gains. So units usually you sell and the gain is arising on sale of the units. That gain is taxable as your capital gain. Units, units. Only plain units. Insurance company usually gives you benefit of life insurance. Now whenever the life insurance sum comes, you learn in income from other sources that life insurance money coming to you at the time of maturity. is an exempt income, is an exempt income. So whenever the money comes from life insurance policy, the policy on your life which you have taken, that policy gets matured, and on the maturity of that policy, if you get some money, that is exempt. Okay, no? So units are your capital asset. Insurance company will give you maturity benefit, that will be exempt. Yes or no? Now the combination of these two items is what? ULIPs. A special type of insurance plan where you pay the premium, you will get the life insurance. But entire part of premium will not go for life insurance. Majority part of that premium will be converted into units. Will be converted into what? Units. And now you have an insurance plan which is unit linked. Unit linked insurance plans. Meaning in that insurance plan, you pay the premium. You pay the premium. Whatever premium you are paying, some part of the premium will be considered for your life insurance. But majority part of that premium will be converted into what? Units. Against that, units will be issued to you. So, keep on paying the premium. Your life is already insured. And majority part of that premium will be converted into units. Now this will happen for some years. Okay, after some years, the policy will mature. And at the time of maturity, what will happen? You'll have to give back that units to the insurance company. You'll have to give back that units to the insurance company, which were given to you at the time when their value was very less. Now after 5, 10, 15, 20 years, your units issued under ULIP will be given back to the insurance company. Whatever will be the value of those units at that time, that amount will come back to you. So units were issued at the time when the prices were less. After certain number of years, when the value of that units increased, at that time, whatever was the value of those units, give the units back to the insurance company. Whatever was the value of that units, to that extent the money will come. So after a few years, the value of units will go down or it will go up. So are you going to get less money or a higher money? Because of that, profit or gain will arise. But that profit or gain, you were not showing taxable under capital gain. What you were saying, the money is coming on the maturity of my insurance policy, which is unit linked. So what? It is my insurance policy. So the money is coming on the maturity of my insurance policy. Hence, this is fully exempt. You used to claim the exemption for that gain by saying that it is money coming from life insurance policy. So what? The life insurance policy is unit linked. So what? But ultimately it is my life insurance policy under which units were issued. Units were issued at a very less price. And at the time of maturity, I gave back my units. At that time, the value of units were higher. That amount was given to me as my maturity proceeds of life insurance policy. Meaning the gain component, capital gain component which was there, you used to claim it as exempt by saying that it is my amount coming from life insurance policy on maturity. If you would have got this gain by buying normal units, you would have definitely paid tax under the head capital gain. But since the units are acquired along with the insurance plan, which is unit linked insurance plan, yes or no? On these units, whatever gain is happening to you, that gain you are getting exempted in the name of maturity proceeds coming from insurance policy, and you are trying to fool us. And this happened for so many years. Few years back, 3-4 years back, they brought one amendment in the definition of capital asset. This is an insurance plan which is unit linked. But since the units gain will be given at the time of maturity, yes or no? And we want to charge that gain also under the head capital gain. So it is very important for us to consider these type of insurance policies also as your capital asset. Hence, point number C. Any ULIPs whose maturity proceeds are not exempt under section 1010D. So there are certain specific type of ULIPs whose maturity proceeds are not exempt under 1010D. So what they thought, what the government said, that this assessee is taking the gain of the units in the form of what? Maturity proceeds, and getting it exempted under section 1010D. So we are not going to give exemption to this amount coming from ULIPs as what? Maturity proceeds. So any maturity proceeds of the ULIPs, specific type of ULIPs, will not be exempt under section 1010D. Why? Because that in that maturity proceeds, a major part is what? Capital gain, which is hidden in that maturity proceeds, which we want to charge under the head capital gain. So first amendment they brought in 1010D, where they said that all types of insurance policies, when you will get maturity proceeds, that will be exempt. But on certain specific type of unit linked insurance plans, whenever the maturity proceeds will be coming, that maturity proceeds will not be exempt. Why? Because we want to charge that under the head capital gain. And in order to charge that under the head capital gain, amendment came in the definition of capital asset, where first they had to include this item as your capital asset, because since it was an insurance plan and the gain in the maturity of this insurance plan we want to charge under the head capital gains. So first make this type of policy as your capital asset, and then there is a specific charge. There is a specific charge, 45 subsection 1B, 45 subsection, and as per that specific charge, the gain arising on ULIPs will also be taxable. Both the things are not in your syllabus. 45 1B not in your syllabus. So getting into detail of this item is not required. Whatever was required, that much I have already explained you. So what is ULIP? ULIP is an insurance plan having the benefit of units. So whenever the ULIPs are matured, at the time of their maturity, whatever the maturity price is coming, in that maturity value, the major component is what? Capital gain on what? Units. And that amount the government does not want to exempt in the form of maturity proceeds of insurance company. So 1010D says that you will get the exemption for maturity proceeds coming from insurance policies. Yes or no? But that maturity proceeds coming from specific type of ULIPs will not be exempt. Now those ULIPs will be covered under capital gains. First of all, those ULIPs will be treated as capital asset, and any gain arising on these specific type of ULIPs whose maturity proceeds is not exempt under section 1010D will now be taxable under the head capital gain as per a specific charge which is given in section 45 1B. That you are not supposed to do right now. In intermediate, this particular 45 1B is not applicable. So whenever we are going to do 1010D, at that time we are not going to talk about these ULIPs because not in your syllabus. Okay. Whenever we are going to do capital gains, in the specific charge, we are not going to talk about 45 1B. So if we are not going to talk about 45 1B, we are not going to talk about this types of ULIPs in 1010D, then what is the point of this particular capital asset? Just a definition. In that definition, this type of asset is also there. That's it. You have to remember that much. Understanding? So 3 points you have to remember. By heart, by heart. Number 1, asset or property of any kind is a capital. Hello, assets, all assets, all assets. Come on, you all are capital assets. So all the assets are covered under the definition of capital asset. First, I am considering everything as a capital asset. Government says no. Defining each and every asset as a capital asset, we might lose some assets. We might lose charging tax on some gains. No. We don't want to take that much risk. No. All the assets. Come on. All the assets. First, you become what? Capital assets. Now wait. Oh, securities and shares held by FIIs. We want to give them the benefit. Okay. So securities and shares held by FIIs as per the SEBI regulations are also capital asset. Oh, ULIPs, certain type of ULIPs. Okay. Maturity proceeds. Gains in the maturity proceeds. They are taking exemption for that. No. ULIPs, certain specific type of ULIPs whose maturity proceeds is not exempt under section 1010D. You also become a capital asset. All assets, all properties of any kind. Capital asset. Shares and securities held by FIIs. Capital asset. Then ULIPs whose maturity proceed is not exempt under section 1010D is also a capital asset. Now these are my capital assets. Any profit or gain arising on transfer of capital asset will be chargeable under the head capital gain. But oops, there are some assets which should not be treated as capital asset. But since we have covered all the assets in the definition of capital asset, these assets are also covered under the capital gain. But this asset, we don't want to consider these assets as capital asset. So hello, assets, you come out. Now there are some assets which we are throwing out from the definition of capital asset. Hence, the term capital asset does not include A, B, C, D, E, F. A, B, C, D, A. Any stock in trade in your business or profession. First question, stock in trade is an asset or not an asset? You write stock in trade in your balance sheet. Hello? On the asset side. Stock in trade you write, no? So stock in trade is your asset. And sir, just now you said asset or property of any kind. Tangible, intangible, movable, immovable, fixed, circulating, whether used for business or not. All the types of assets are capital assets. So all the types of assets are capital asset. In that definition, I have covered all the assets. Stock in trade. Stock in trade. Please stand up. Stock in trade, please stand up. We don't want to consider you as a capital asset. So I am bringing the stock in trade outside the definition of capital asset. But wait. Stock in trade. Oh, shares and securities held by FIIs. You are also stock in trade. You are not excluded. You are specifically included. So will you remove all the stock in trade? Will you remove all the stock in trade from the definition of capital asset? Yes. But while removing that, don't remove the shares and securities held by FII. We have specifically included it. Understanding? So shares and securities held by FIIs. Other than that, what did I say? Other than that, any stock in trade in the business will not be treated as capital asset. Reason? Very simple. The profit or gain arising on stock in trade, we are already charging under the head PGBP at normal rates. And if we don't exclude the stock in trade from the definition of capital asset, the profit or gain will be again taxed under the head capital gain. So one profit or gain will be taxed twice. Once under the head PGBP, second under the head capital gain. We don't want to charge it twice in two different heads. We want to charge it once. Where? PGBP and not under the head capital gain. Hence, stock in trade is not a capital asset. Understood? Yes or no? So the term capital asset does not include following assets. Number one, any stock in trade other than securities held by FIIs, because that stock in trade is specifically included in the definition of capital asset. Don't exclude that. Other than the shares and securities held by FII, any stock in trade is there that is excluded from the definition of capital asset. The profit or gain arising on that stock in trade will not be taxable as your capital gain. We want to charge it under the head PGBP at normal rates. So the stock in trade is excluded from the definition of capital asset. Point number one clear? Point number one clear? Point number two, movable person. Sir, all assets. All assets are? All assets, all properties are capital assets, no? All the assets, all the properties are capital assets. Now in my capital assets, no, there are some movable assets. There are some movable personal effects. They are my personal effects. My clothes, my specs, mobile phone, hello, my motorcycle, the car which I drive, the furniture at my home, my personal music system, TV at my home, utensils at my home, yes or no? So all the personal belongings means personal effects are also my asset only, no? Hello sir, is my mobile phone my asset? Yes, it is a property, it is my asset. But do I use it for my personal purpose? Yes. The furniture at my home, the utensils at my home, my clothes, my motorcycle, my car, music system, television, microwave oven, all the personal belongings which are movable in nature. So they are known as movable personal effects. Any asset, any property which is used by the assessee or any of his family members for personal purpose. Any asset, any property used by the assessee or any of his family members for personal purpose, and that property is a movable property. This wristwatch, clothes, utensils, furniture, yes or no? What are these? Movable. And they are personal effects. So since I have covered all the assets, any type of asset, any kind of asset in the definition of capital asset, they are also covered. But the government does not want to cover them in the definition of capital asset. So hello, all the assets, all the properties of any kind, you all are my capital asset. So hello, movable personal effect. Movable personal effect. Stand up, get out. We don't want to consider you as a capital asset. The term capital asset does not include what? Movable personal effect. Meaning, I'm throwing the movable personal effect out of the definition of capital asset. First, all the assets are included. Now, from these assets, I'm throwing out what? Movable personal effects. What is movable personal effect? You came to know, na? Yes or no? Examples I gave, you came to know, na? Now tell me, movable personal effects are not my capital asset. Why? The government does not want to consider them as capital asset. Why? So what? Even the house property in which I stay is my personal asset, but that is not excluded. That is my capital asset. So the house property in which I am staying, me and my family members are staying, that house property is also used for personal purpose. That is a capital asset. That is not excluded. Only the movable personal effects are excluded. Why? What GST? Common sense, which is very uncommon. Bloody, if I'll buy any movable personal effect, for example, I'm buying an iPhone. Today, iPhone 17 Pro Max, 1,50,000. The moment I'll open the box, no, even if I'm not used, the value will start coming down. I'm going to the shop. I'm giving 1,50,000 for iPhone. The moment 1,50,000 will be given and I'll buy that iPhone and I'll step down of that store, the value from that time only will start coming down. Over a number of years, whenever these assets are being used, their value never goes up. Their value keeps on coming down. Now just imagine if I have bought this shirt for 2000 rupees. After wearing this shirt for some time, if I will sell this shirt, will this shirt be sold for 50,000 rupees? Nobody will be giving me 500 rupees also for this shirt. Utensils at my home, mobile phones, motorcycle, these car, the furniture at home, TV, microwave oven, all these assets which are used for personal purpose, which are movable in nature, they tend to lose their value over a period of time. Their value keeps on coming down over the period of their use. So the more you will use, the more its value will come down. So tell me, if I buy one asset, mobile phone, for 1 lakh rupees, after some time its value will go up or will come down. So I'll be able to sell it for 1 lakh or less amount. I'm selling it for 30,000. How much? So will I incur a loss or I will get a gain? Always, in the majority of the cases, what will happen? Loss will arise. What will arise? And just imagine, if the loss is arising, in majority of the cases, almost every case of movable personal effect, the loss will arise, and still we will consider this item as capital asset. What the assessors will do? Whenever there are huge capital gains, no? Hello? In that year, they will sell their movable personal effects and they will compute losses, and those losses they are going to set off against taxable capital gains. And they are not going to pay tax on the taxable capital gains. Why? Taxable capital gain was some amount that they will reduce by setting off these losses, which they are definitely going to get by transferring their movable personal effect, because movable personal effects are never going to give you any profit. Over a period of time, their value will come down, so they are going to be sold at a loss only. So losses they will compute by selling these type of assets. Those losses they will set off against the taxable capital gains. Thereby, the taxable capital gains will come down and the government will not get taxes on gains. So we don't want that thing to happen. Knowing that this asset is not going to give you any profit in the future, why to keep it as your capital asset, not your capital asset? Enjoy. So hello, all the assets, all the properties are what? Capital asset. Which asset you are throwing out? Movable personal effects. What did I say? Movable personal effect. I am throwing out from the definition of capital asset. It is not treated as my capital asset. Why it is not treated as my capital asset? Did you understand? Logic you understood? Wait. Movable personal effect going out. But PJ Das is also going. So when I said no, movable personal effect is excluded. I said movable personal effect, get out. Movable personal effects are going out. But along with movable personal effect, PJ Das is also going out. I said, hey, PJ Das, paintings, jewelry, drawings, artwork, archaeological collection, sculptures and shares. They are also going out. So I said, why are you going out? You said, no, movable personal effect, go out. So we are also movable personal effects. No. We are saying movable personal effect go out. We don't consider you as movable personal effect. So you don't go out, you stay here only. P for paintings, J for jewelry, D for drawings, A for artwork, A for archaeological collection, S for sculptures and shares. Yes or no? Even they are personal assets only. Even they are used as personal items. But they will not be excluded from the definition of capital asset. Because we don't consider these items as movable personal effect. So from the definition of capital asset, movable personal effects are eliminated, but from the meaning of movable personal effects, PJ Das is excluded. Meaning, exclusion of exclusion is inclusion. Minus, minus, plus. So from the definition of capital asset, what are you minusing? What are you reducing? Movable personal effect. But movable personal effect, from this, what are you reducing? PJ Das. So minus, minus will become plus. So they are treated as your capital asset. Don't try to exclude these type of assets because they are not treated as movable personal effect. Why? Reason very simple. Sir, PJ Das, over a period of time, their value will not come down. Their value will go up. Just imagine, the more older these assets will get, the more valuable they will get. If a jewelry which was bought 50 years back, jewelry which was bought 50 years back, or just say no, 10 years back only, what will be the value of that jewelry right now? Do you know the gold prices right now? It has crossed 1 lakh rupees. And at 10 years back, it was below 50,000. At that time, the jewelry was purchased when the gold prices were less. Over a period of time, gold prices have gone up, and because of that, the value of the jewelry has also gone up. So the PJ Das, these assets I'm telling you, no, even if these assets are used for personal purpose, yes or no, even if they are movable, but we don't consider them as movable personal effect. Why? Because over a period of time, their value is going to increase only. And what if we want to charge tax on the gain arising on these assets? We'll not be able to do if we will exclude them also. So while excluding movable personal effects, we are not going to exclude PJ Das. It will remain as your capital asset. P for paintings, J for D for, sir, paintings and drawings. Some confusion is there. What is the meaning of painting? And what is the meaning of drawing? None of your business. What did I say? None of your business. Sir, by mistake, no. I don't get the difference between painting and drawing. No. So sometimes, by mistake I call drawing as a painting. Or sometimes by mistake I call painting as a drawing. I don't know the difference only. Can you please tell me the difference? Even I don't know. Seriously, I'm telling you, even I don't know. Because why would I worry that an item is a painting or a drawing? Even if I call it a drawing, it is to be treated as a capital asset only. And even if I call it as a painting, it has to be treated as a capital asset only. Something which has color is a painting. Something which is not having a color is a drawing. That's it. Common sense. So I applied that common sense, but that common sense is not working. I was thinking that something which is not having color is a drawing. But shit, that was a painting. So what? It is still a capital asset only. Understanding? So don't waste your time in all these things, nonsense things. P for painting, D for drawing. One and the same thing. Understanding? If you call it a painting or you call it a drawing, at the end of the day it is a capital asset. The more older they are, the more valuable they will become. The paintings made by Picasso, the paintings made by that Mona Lisa painting was made by Leonardo da Vinci. Yes or no? Those paintings are so valuable, bloody, that the more older they are becoming, the more valuable they are becoming. People are ready to pay like crazy for these items. 100 years old painting of some famous, painter at that time. If you want to buy that painting right now, it will cost in crores. And somebody is having that painting, will sell it for crores will get crores of rupees of capital gain, and the government wants to charge tax on that. Hence, it is a capital asset, not a movable personal effect. Yes or no? Now tell me, drawings means sometimes there is a Taj Mahal hotel in Mumbai where the terrorists attacked 2011. Yes or no? 9/11 attack happened. 9/11, no? It was 9/11 only, okay, no? So, that entire blueprint of that hotel. So, some big architect would have made that hotel. So, while constructing that hotel, the architect would have made the drawings. Now, that drawing is a drawing of Taj Mahal hotel. Can be a drawing of Taj Mahal also, made by Shah Jahan. Just imagine these type of drawings, maps, etc., which are very valuable things. The more older they will become, the more valuable they will become. Jewelry means what? So I will have to explain each and every item to you. Only then you will understand. Jewelry means what? Whatever you understand is a jewelry. But that itself is not a jewelry. Something else is also jewelry. So, what is the meaning of the term jewelry? So, I'll tell you what is the meaning of the term jewelry. Okay, no? Pay attention over here. Meaning of the term jewelry. In your income tax act, no? Jewelry means what, you know? Jewelry means any precious or semi-precious metal or alloy. Sir, metal I understood. I did not understand alloy. What is alloy? In the childhood, you might have studied science, chemistry. Huh? In chemistry, there was a concept of metals and metallurgies. Yes or no? One metal is a metal. Another metal is also a metal. When you mix both the metals, a new metal comes into existence. Is known as, it is a mixture. Mixture of more than one metals. Mixture of more than one metal. So, if I am holding gold, and I am holding platinum, precious metal, hello, will be my capital asset. So what I did? I mixed gold and platinum. Now, it is not a metal. You said that metal is a capital asset. No. We are saying alloys is also a capital asset. Not just the precious or semi-precious metal. But if you combine them and form some another metal, alloy, yes or no, even that alloy will be covered in the definition of jewelry. So, jewelry means what? Any precious or semi-precious metal. By the way, iron is not precious, semi-precious. I have some items made up of iron. Is it a jewelry? Why? Because that item which is made up of iron is not a precious or semi-precious metal. The metal which is very much scarce, very much costly, is known as what? Precious metal. Okay, no? So, if you have any precious or semi-precious metal or alloy, now you can keep the metal as it is with you. Can you keep this metal as it is with you? So, when you keep the metal as it is, kept as it is, then that is known as bullion. That is known as bullion. You will keep it in the form of coins, You will keep it in the form of bars. You will keep it in the form of biscuits. Yes or no? So if you keep the metal as it is with you, precious or semi-precious, metal or alloy, as it is with you in the form of bullion, then bullion is equal to jewelry. Bullion is equal to, and if it is a jewelry, it has to be your capital asset. Understood? Now, sometimes you convert them. Sometimes you convert the metal. Converted into what? Into ornaments. You make ornaments out of it, no? Ornaments. Converted into wearing apparels. Like studded in, silk saris are there, Silk saris made with golden thread. That is a real gold. So any sari having a gold border, and that gold border is made up of pure gold. So then that sari does not remain a sari. It is not a personal effect. It becomes your jewelry. You will not wash that sari just like your other clothes. Will you give that sari to that maid who is coming at your home to wash the clothes? Your sari will disappear. Because that is very valuable. That maid will run away with that sari. Understanding or not? But she will not run away with your normal clothes, no? And you will not keep these items as your normal movable personal effect. You will try to keep them safe, just like some valuable item. So any metal or semi-precious metal which is converted into what? Ornaments, like chains are there, bangles are there, yes or no? Then earrings are there. All those are what? Ornaments. So you have converted the metals or semi-precious metal, precious or semi-precious metal or their alloys into what? Ornaments. You can convert them into wearing apparels. You can convert them into furniture also. Yes. People get the furniture also made. Whenever they are making their furniture, they use precious and semi-precious metal. Handles of the chair are made up of pure silver. Yes or no? Silver plates are used in my chair which I am sitting at home. So the chair in which I am sitting at my home, I want to feel like a king. So I have made up the handles made up of silver, gold, yes or no? All the four legs are made up of gold, silver. Then that is not my normal furniture now anymore. That has become a jewelry. So all these items, if I keep as it is, then also a jewelry. And if I am converting them into all these forms, then also it is treated as what, sir? Then it is treated as jewelry. And if it is treated as jewelry, it has to be my capital asset. If I sell all these items, they will be treated as capital asset. Yes or no? Now pay attention. Any precious or semi-precious stones, any precious or semi-precious what? Stones. Stones means diamonds are there, then ruby, sapphire. Can you see these two finger rings? The finger rings, this is yellow color stone. This is known as yellow sapphire. Yellow sapphire, yes. In Hindi you call it pukuraj. And this is blue sapphire. Now this is what? A stone only. But this is a precious or semi-precious stone. Okay, no? I can keep the stones like this only. Pearls are there, rubies are there, emeralds are there, then diamonds are there. They are what? Stones only. Stones of different colors, so attractive to see. Yes or no? People keep them as it is also, or people can convert them into ornaments, furniture, wearing apparels. Yes or no? So whenever these stones, which are precious or semi-precious, I'm not talking about the stones which are there on the road. They are not precious or semi-precious stone. You'll bring some stone from down in the break. Sir, this is also a capital asset. No, I'm not talking about all the stones. And nobody will keep such type of stones in their almirahs, cupboards. Cupboard open, so many stones are coming out. Few stones you have collected from railway stations. Those big stones. Are these precious or semi-precious stones? No. So I am talking about only those stones which are precious or semi-precious. Now, can you keep these as it is? Yes or no? Can you keep them as it is? Yes. And you can convert them into some ornaments, wearing apparels, etc. So if you keep them as it is, then also they are treated as your capital asset. Yes or no? And if you are converting them into some ornaments, wearing apparels, or some furniture, etc., then those items will also be treated as your jewelry. Understanding? And will be treated as your capital. This is the meaning of jewelry. If you see any of these items, what are you going to consider them? Jewelry. Jewelry. And these items are treated as jewelry, hence they are capital asset. P for paintings, D for drawings, both the things done. J for jewelry. Meaning of jewelry is this, okay? A for artwork. Artwork means many artists are there, they do different art forms. Okay, no? So different works which they are doing from their art, different things they are going to make. So the more older these items become, the more valuable they will become. Yes or no? Any artwork is there, any archaeological collection is there, the things which come out of the ground. Okay, I purchased some land to do my farming activities and all, or to do some construction activity. Okay, so while I took that land, now to start I was about to start the construction. So to lay the foundation of my construction, I started digging that land. While digging, one big box came out of my land, and that big box had so many old items, 500 years old, 200 years old items, which were there in that box. Harappa, Mohenjo-daro, if you know about that, Indus Valley civilization, thousands of years back, people used to live in this area, and they used to use these kind of items to eat, to drink water. See, these type of small glasses are there. So at the time of digging, all these items are coming out of ground. So all these items are what? Archaeological collections. Very valuable items, very valuable. Okay, now? And more older they will be, more valuable they will be. Understanding? Okay. Now, next, archaeological collection, and then sculptures. Different types of sculptures. Okay, no? Idols made up of any metal, it can be made up of any stone, it can be made up of any item. So different types of sculptures, which are very old sculptures. Okay, no? Those are also treated as your capital assets. So P. J. Das, will you consider them as a capital asset? Yes. Don't consider them as movable personal effects. You are not supposed to exclude them along with movable personal effects, because they are not treated as your movable personal effects. So number one, what is a capital asset? The term capital asset means, the term capital asset means asset or property of any kind. Asset or property of any kind, whether tangible, intangible, movable, immovable, fixed or circulating, whether used for business or not. All the items are treated as your capital asset. Number 2, shares or securities held by FIIs as per the SEBI regulations of Indian companies. Yes or no? They will also be treated as capital asset. Next one, ULIPs whose maturity proceeds not exempt under section 1010D. Those ULIPs are also treated as capital asset. But the term capital asset does not include, number 1, stock in trade. But when you exclude stock in trade, don't exclude the shares and securities held by FII, because they are specifically treated as what? Capital asset. In the definition of capital asset, they are specifically covered as capital asset. Second one, you have to exclude movable personal effects. Movable personal effects are not your capital asset. But whenever you are excluding movable personal effects, don't exclude PJ Das. They are still your capital assets. So P for painting, J for jewelry, D for drawing, A for artwork, A for archaeological collection, S for sculptures and shares. Yes or no? They are treated as your capital asset. Now, one question. The house property in which me and my family, we are living, isn't it a personal asset? Will it be treated as a capital asset? Try to move that house property. Will it move? So even if it is used as personal asset, since it is not moving, or you cannot move this type of asset, then will it be called as movable personal effect, or it is an immovable personal asset? What are you going to exclude? All the personal assets or only movable personal effects? And if you will try to move this house property, it will not move only. Why? Because it is not movable, immovable. We are telling you to exclude movable personal effects. And while excluding movable personal effect, how can you exclude an immovable item? How can you exclude the house property? Did we tell you to exclude this also? We are not telling you to exclude all personal effects. No. We are telling you to exclude only those personal effects which are movable in nature. Hence, very specifically I have written over here. What? Movable. What I have written? Movable personal effects. Because their value keeps on coming down over the period of years, over the period of their use. Yes or no? And movable personal effect does not exclude PJ Das. Movable personal effect does not exclude PJ Das because their value does not come down, their value goes up over a period of time. Therefore, they are treated as your capital asset, and movable personal effects are not treated as your capital asset. And the residential property which is in personal use of the assessee or any of his family members, yes or no? This residential property is also an asset used for personal purpose. It is also a personal effect. But since it is not movable, it is immovable, you cannot exclude it because we have to exclude only the movable personal effects. And since it is not a movable personal effect, you don't have to exclude this from the definition of capital asset. So it will still be treated as your capital asset. So the residential property in which assessee and his family members are living is a capital asset. Gain will arise on their transfer, will be taxable under the head capital gain. Understanding? Next one, rural agricultural land. If you remember my yesterday's lecture, in my last lecture yesterday, what I told you? Any income on transfer of urban agricultural land will not be treated as agricultural income. So that implies that the income on transfer of rural agricultural land will be treated as agricultural income. And just imagine if the rural agricultural land remains your capital asset, so its income will be taxable under the head capital gain. But we want to exempt this income as what? Agricultural income. So this should not remain your capital asset. Hence, it is excluded. It is excluded because the income arising on transfer of this asset, they want to treat as what? Agricultural income. And if it is not excluded, what will happen? It is a capital asset. The income arising will be taxable as what? Capital gain. But we don't want to charge this amount under any of the heads. We want to exempt this amount. So how this will be exempt? We have covered all the assets in the definition of capital asset. By mistake, this rural agricultural land is also an asset. It is also covered in the definition of capital asset. Getting my point? So they are saying that please exclude rural agricultural land. We don't want to consider this as a capital asset. We don't want to charge the gain arising on transfer under the head capital gain because we want to exempt it as your agricultural income. So to exempt it as your agriculture income, first this should not be treated as your capital asset. Did they exclude urban agricultural land? Why? Because income on transfer of urban agricultural land is not a agricultural income. We want to charge it under the head capital gain. So urban agricultural land should remain as your capital asset. Hence we are not excluding that. Understanding? So which land is excluded? All land will be excluded, no? Any land. Only the rural land. No, rural agricultural land. So now land can be rural, land can be urban. And I have already explained yesterday which type of land is a rural land, which type of a land is a urban land. Yes or no? I'm not going to explain that again. Okay? So now tell me, land can be rural, land can be urban. In the rural area, you can have agricultural land also, non-agricultural land also. In the urban area, you can have agricultural land also, non-agricultural land also. So which land is excluded? Rural agricultural land is not your capital asset. All other lands are capital asset. Whether it is rural non-agricultural land, whether it is urban agricultural or urban non-agricultural land, any type of land is a capital asset. Capital gain will arise on transfer of land also. Yes or no? But rural agricultural land will not be treated as capital asset. Why? Because the income arising on transfer of rural agricultural land has to be exempted under section 10(1) as your agriculture income, and that is possible only if we exclude this item from the definition of capital asset. Understanding? Income arising on transfer of urban agricultural land is a agriculture income or not an agriculture income? Hence that urban agricultural land is not excluded. See, it is still urban agricultural land is still your capital asset. So income arising on transfer of urban agricultural land, which will not be treated as agriculture income, will now be treated as capital gain, taxable under this head. Will you remember this? So first asset, which is not a capital asset. Stock in trade. Other than shares and securities held by FIS. Number 2, movable personal effects. Other than PJ Das. And see, residential property used for personal purpose is not a movable personal effect. Hence it is also a capital asset. Third asset, rural agricultural land. Rural agricultural land is not a capital asset. Any other land, whether it is a rural non-agricultural land, capital asset. Urban agricultural land, urban non-agricultural land, all the land is a capital asset, but rural agricultural land is not a capital asset. Next one. Now we are talking about gold bonds. Which bonds? So gold bonds were issued earlier are known as old gold bonds. And few gold bonds are issued, in the recent times in the form of sovereign gold bonds, SGBs. Okay, they are treated as new gold bonds. So now gold bonds are of two types. Gold bonds are of first old gold bonds. First old gold bonds. Now sir, old gold bonds are those gold bonds which were issued by the government long back. 6.5% gold bonds, 1977. 7% gold bonds, 1980. National Defense Gold Bonds, 1980. So the year is written. In that year, these gold bonds were issued by the government. Somebody might still be holding those gold bonds. Yes or no? Now tell me, if the gold bonds were issued by the government, you have purchased the gold bonds. So gold bonds is also your investment, meaning your asset. Has to be your capital asset. But they are saying no. All assets are capital asset, but the old gold bonds issued earlier in 1977, 1980, all those old gold bonds are not treated as capital asset. Exclude them from the definition of capital asset. So will there any capital gain arise? No. And also the interest which you receive on such gold bonds, that interest will also be fully exempt under section 10 subsection 15. So there is one section 10-15. You are going to learn this section 10-15 in IFOS with me. So in 10 subsection 15 under the head IFOS we are going to have a reference of 10-15 there. Yes or no? That time again this point will come, that any interest on these gold bonds will also be exempt income, and further these gold bonds itself will not be treated as your capital asset. Government wanted to motivate the assessees, investors, to invest in gold bonds rather than investing in physical gold. Because bloody, if you buy the gold, no, what happens? At the end of the day, you keep that gold in your cupboard only. You don't use it on a regular basis. And still you are demanding for that gold. And to meet that demand of gold, the government has to import gold, you know. We don't produce gold in India that much. So, India is one of the producers of gold, but we don't produce huge amounts of gold. Out of the total production of the world, India produces nearly 2 to 5% of gold. Yes. If 100 tons of gold is produced in the entire world, no. Only 2 to 5 tons gold is produced by India. So in terms of production, we are very, at the down the table. Why? Because there are no gold reserves available with India. Maybe they are available, but it has not yet been explored. Understanding what I am trying to tell you? So gold reserves are not there. We are not able to produce that much amount of gold. But every year we consume gold crazily. So the consumption of gold in India is a crazy type of consumption. Buddy, we just find some excuse to buy gold. Deepavali, we'll buy gold. Dhanteras, we'll buy gold. Wedding, we will buy gold. Then Akshay Tritiya, we'll buy gold. Whatever festival is coming, we are going and buying gold. And after buying gold, what we do? We don't use it on a regular basis. Can you see any gold chain in my this thing? No. I have 4 gold chains. Seriously, I'm not kidding. Huh? I have 4 gold chains, which my mother has bought for me. But whenever I ask her, give me one gold chain to wear, she'll say, you are not able to manage yourself. How are you going to manage? You're not able to take care of yourself. How are you going to take care of gold chain? So costly gold chain, if you'll wear, you'll lose it. My mother even does not trust me for that. And whenever I'll ask, see, Gokul will also relate to this. Usually earlier what used to happen, my father used to give money to my mom when he used to earn. My mom used to save that money, and by saving that money, small amounts, my mother used to buy gold or gold jewelry. Okay. Now since the time I have started earning, no, my father has stopped earning. He is retired now. Okay. He is living a good old life. Okay. I am the earning member at my family, and I am earning good amount every month. So out of that amount, as a responsible son, I give some amount to my mother. Okay. Not to spend, because none of the spending is done by my father or mother. All the spendings are done by me. All the household stuff bought by me. All the payments are done by me. So they don't have to pay for anything. Okay, no. But I still give them the money. As a responsible son, if your parents are not earning, no, so they should not be feeling like, beggars with you. They don't have to ask for money every now and then. Because the time when we were kids, they took care of us. So now it is our responsibility to take care of them. Even if they are not required to spend any money, no, still I give money to my mother. Every month, fixed amount I'll give. And sometimes, happily, I'll give more amount also. My mother does not spend a single rupee out of that. Because all the expenses are made by me only. Okay, no? What my mother does, she saves that money. And after 4 or 5 months, she'll save. And she'll ask. She'll ask me that let's go to some jeweler shop. Yes, she'll definitely take me to a jeweler shop. And from that jeweler shop, she'll either buy some coins or she'll buy some small, items made up of gold. Like sometimes she'll buy pendants, sometimes she'll buy earrings, not for herself. She wears very less gold. But whatever she'll buy for my sisters, she'll buy for my nieces, my nephew, okay? She'll buy something for myself. Like this, she has bought 4 gold chains for me. 4 gold chains. The first time when she bought a gold chain for me, I become so happy, that my mother has bought a gold chain for me. Okay? And I was so excited to wear a gold chain. So the moment we came home with that gold chain, see, in our homes, what we do, whenever we buy some gold item, after coming to home, we directly keep that item in front of the God. Okay? So it was kept. Night we came and we kept that gold chain in the temple at my home. Okay, no? And morning, I was so excited. I got up early. I took a bath and everything. And in the morning when I go to, in my puja room, where I go, and I saw that the gold chain box which I kept last night is not there. And the maid was working at home. Immediately I thought, oh my God, where is the gold chain box? I asked my Amma, Amma, I kept it inside. I said, why? She said, it is not to be worn by you. He said, then why the bloody hell you have bought it? Taking my name. I'm buying this for you. I was so excited. I got up early in the morning thinking that I'll be able to wear that chain from today. Buddy, you are not able to take care of yourself. Will you be able to take care of this gold chain? And that was costly. Heavy chain. So that was costly. She told me, no, not to be worn on normal occasions. Some special occasions, some functions are there, no? At that time I'll give you. I said, no problem. After a few months, there was some relative, not close relative, but relative, there was a marriage in that family. So that time I was very excited. That mother had told that I'll be able to wear it in some festivals or some functions. So today is a function. So I asked my mother that, Amma, you told that in some function, etc. you will give. My mother is saying, this is not our own function, huh? Since then it is lying in the cupboard only. And after that also, taking my name, she has bought 3 more gold chains. Indian families are like this only. And just imagine, if you will go and see my cupboard right now, cupboard of my mother, she is having so many items like this, small items, made up of gold, made up of silver. She saves money and she buys. She saves money and she buys. And after buying, she's keeping in cupboard. Every household, if you'll go to your house also, no, you'll get that same thing. Your mothers would have bought so many items which you are also not aware, and if you'll ask one fine day, no, she'll show you, see, I bought these many things for you. These many things for me, even I was not aware. Every household in India has this story, same story I'm telling you. Whether you go to north, whether you go to south, whether you go to east or west, every household has having this story. What we do? We find the reasons to buy gold. When the gold is bought, we don't use it, we store it in the cupboard. And unnecessarily, because of that, the demand of the gold is increasing. The people in India are demanding gold crazily. They consume gold crazily. Out of the total world consumption, India consumes approximately 12 to 15% of gold. Minimum, I'm telling you. That data has gone up. That number has gone up only. And how much we are producing? Only 2 to 5%. So, can you see the gap? So, to fill up this gap, what has to be? Demand is more, supply is less. So, the gold has to be imported from outside India. And to import that gold, a valuable foreign currency is used. So, some gold will be imported from Arab countries. Some gold will be imported from South Africa. So, these are the countries from where we'll usually import the gold. And for that imported gold, we have to use the foreign currency, foreign exchange reserves to pay for that import of gold. And that way the foreign currency reserves are coming down. And at the end of the day, foreign currency reserves are coming down because the government has to pay for import of the gold, yes or no? And that gold which is coming to India, that is not being used on a continuous basis, that is bought and that is kept in the cupboards. But if you want to keep the gold in the cupboard only, then why are you demanding gold? We are giving you some better alternative of the gold. Alternative of the gold which is better than gold. We are issuing gold bonds. So if you have money, instead of investing that money in the gold, why don't you invest in gold bonds? So what is the benefit? The value of these gold bonds will be directly proportionate to gold. If the gold value will go up, the value of these bonds will also go up. Same proportion, same proportion. Not a single rupee difference. Yes or no? The value of gold will come down. The value of these gold bonds will also come down. So the appreciation or the depreciation in the value of these gold bonds will be directly proportionate to the value of the gold. So if you want to invest 1 lakh rupees in the gold, after one year, the gold will become worth 1,20,000, and that same 1 lakh rupees, if you will invest in the gold bonds, after 1 year, these gold bonds will also become 1,20,000. On top of that, the gold will not give you any returns in the form of interest. This is going to give you interest also. And that interest also we are going to exempt. Better alternative. Gold is not a safe item to hold. Because if it is lost, your name is not printed on the gold. Whoever finds that gold, the gold belongs to him. Because your name is not printed on the gold. But your name will be printed on these gold bonds. Even if you lose it, it is still yours. Safety. You will wear the gold chain and go out. People will do chain snatching. Wear this and go out. People will not come near to you. Have a gold bond hanging in your, people will not come near to you thinking that mad fellow wearing paper and going out. Safe, secured, same as gold. No, better than gold. If you will sell the gold is a jewelry, capital gain will arise. Sell this, capital gain will not arise because this is not a capital asset only. So many benefits the government has given. Now, if you want to invest your 1 lakh in the gold just for the purpose of investment, invest in gold bonds, no? So different times in the past, to reduce the imports of the gold, the government issued these type of bonds. Okay. So these bonds are what? An alternative for gold. So you can buy gold bonds also. Whenever you will buy the gold bonds, remember the gold bonds will not be treated as your capital asset. Any appreciation which you will realize on selling these gold bonds will not be taxable under the head capital gain, but the appreciation in the value of gold realized on sale of the gold will be taxable under the head capital gain, because gold is a capital asset, whereas the gold bonds are not capital assets. Will you remember this? And will you get any interest on the gold? No. Will you get any interest on the gold? No. But will you get any interest on the gold bonds? And that interest will also be fully exempt. Understood? But after these gold bonds were issued, for many years the gold bonds were not issued. So in the year 2015, government came up with a scheme. The name of that scheme was Sovereign Gold Bond Scheme. 2015. Which? Sovereign Gold Bond Scheme 2015. Under that scheme, now new bonds are issued, known as new gold bonds. So these gold bonds which are issued right now as per the new scheme of the government. What is the name of that scheme? Sovereign Gold Bond Scheme. So the gold bonds which are issued under the Sovereign Gold Bond Scheme 2015. 2015, the new gold bonds are issued. Those gold bonds are known as sovereign gold bonds. Which bonds? Under the Income Tax Act, nowhere it is written that this will not be treated as your capital asset. Nowhere it is written that it will not be treated as your capital asset. Meaning, if you buy sovereign gold bonds, they are not excluded from the definition of capital asset. So, can I say they are still treated as your capital asset? Yes or no? And if you will transfer them, the capital gain will arise. But wait, if the new gold bonds, meaning sovereign gold bonds, which are your capital asset, if they are transferred by an individual, by way of redemption or maturity, then this transfer is known as exempt transfer under section 47. So there is one section 47, which says that the transfer of gold bonds, sovereign gold bonds, by an individual at the time of their maturity. So when they will be matured, you are supposed to give the bonds back to the government, yes or no? And in return you are going to get the money. So you are transferring your gold bonds. The moment you are, giving your bonds to the government on the maturity, against that, whatever value of that bonds will be there at that time, you will get that value. Gain will arise at that time. But that gain will not be taxable. The gain happening at the time of maturity will not be taxable. We don't want to charge tax on that gain. Hence, that maturity of the sovereign gold bond, that maturity is treated as a exempt transfer. But if the bonds are matured in the hands of an individual. So if you are an individual, you have acquired the sovereign gold bonds and you are holding those sovereign gold bonds till the time of maturity. At the time of maturity, whatever gain will arise, that gain will not be taxable. But for that, you have to hold it till maturity. Hello? So any gain arising at the time of maturity in the hands of individual who has invested in these bonds will not be taxable, even if they are capital asset. Still it will not be taxable, because that transfer at the time of maturity itself is treated as an exempt transfer under section 47. So capital asset is there, but taxable transfer is not happening. The transfer is exempt transfer. Capital asset should be there and the taxable transfer should be there. Only then profit and gain will be calculated and will be taxable. Capital asset is there, But the transfer is not a taxable transfer. Transfer is an exempt transfer. Hence, the profit or gain will not be calculated and no capital gain will be taxable. Understanding? Tell me yes or no. So at this time, the capital gain will not be taxable because the transfer itself is an exempt transfer. Now, if the sovereign gold bonds are transferred in any other case, then 100% capital gain will arise and it will be taxable. Only this type of transfer of sovereign gold bond is treated as exempt transfer. Otherwise, any other type of transfer of sovereign gold bond is a taxable transfer, and sovereign gold bond is a capital asset also. Profit or gain will be calculated also and it will be taxable also. Will you remember this? Everyone tell me yes or no. Sure, sir. So first of all, gold bonds. How many types of gold bonds? Two types, old and new. Old gold bonds, capital asset, not a capital asset. And any interest on such old gold bonds is also exempt under section 10(15). New gold bonds are known as sovereign gold bonds, which are issued by the government under the sovereign gold bond scheme. These new gold bonds, meaning sovereign gold bonds, nowhere it is written that these are also excluded, meaning they are treated as your capital asset, they are treated as your, and if they are transferred, the capital gain will also arise and it will also be taxable. But if their transfer is by an individual at the time of maturity, then that transfer is also treated as exempt transfer as per section 47. And since the transfer itself is exempt, so even if it is a capital asset, no capital gain will be taxable. On what? Maturity. On maturity. In the hands of individual. Why? Because the asset is not a capital asset. No. Asset is a capital asset. But the type of transfer which is happening, that transfer is not a taxable transfer. The type of transfer is exempt transfer. Hence, there will be no capital gain. In every other case, if the transfer is made, then that transfer is a taxable transfer and the capital asset is also there. That time the capital gain will be calculated and it will be taxable also. Okay. And any interest, what did I say? Any interest on the sovereign gold bonds. On the sovereign gold bonds, interest on sovereign gold bonds, SGBs, okay, no, that interest is taxable under the head IFOS. That interest is not exempted. So first of all, they are your capital assets also, and their interest is also not exempted. Their interest is also not exempted. Their interest is taxable as your income from other sources. Will you remember this? Hello, sir. Now see, now there are gold deposit bonds. Gold deposit bonds can be there, and gold deposit certificates can also be there. So gold deposit bonds are known as GDBs. And gold deposit certificates are known as GDCs. These bonds are issued under the Gold Deposit Scheme 1999. And the gold deposit certificates are issued under Gold Monetization Scheme 2015 by the government. So government has brought two schemes. One scheme was brought in 1999. The name of that scheme was Gold Deposit Scheme. And another scheme they have brought in 2015, 10 years back. Okay, no? The name of that scheme is Gold Monetization Scheme. So under both the schemes, the same thing will happen. Do you have gold at your home which you are not using? You have just kept that gold for the sake of investment, yes or no? Or some old gold jewelry, broken gold jewelry, yes or no? So whatever gold jewelry which is available with you, come bring that jewelry to us, deposit that jewelry to us. The jewelry value of that jewelry will be calculated. For that value, a bond will be issued. A certificate will be issued. So what the government is doing now, by doing this, government again wants to reduce the imports. To reduce the import, this is another step taken by the government. Issuing gold bonds will give you the option to invest in bonds other than gold. Okay, no? But those bonds cannot be issued again and again by the government, no? Getting my point? So what the government has said, whatever number of times we are going to issue the bonds, that time the gold demand will come down. Then again after some time, the people will again start asking for gold. And that time, again we'll have to bring that gold from outside India. So, that outside India which the gold will come, people will buy that and again put that gold in the cupboards. Since so many years, people have been doing this. We are importing gold. They are buying gold, keeping in the cupboard. We are importing gold, buying gold, keeping in the cupboard. So the government very well knows that for these many years, whatever gold we have imported, that gold is lying in the country itself. In different cupboards, in different households. So instead of bringing new gold to India, why not to take this gold only out of the cupboards and circulate that gold in the economy? So there will be no requirement of importing new gold. So our gold only, we will tell the people to deposit to the government so that government can circulate that gold in the economy once again. No need to buy new gold from outside India, because we have huge amount of gold which we have imported for so many years lying in the country itself, in different household, in different cupboards. Understanding? So the government is offering you, hello, Azazis, you have gold lying at your home, very risky. Somebody will come, steal it, you'll lose it, the person will find it, will belong to him, yes or no? And always you are in the tension that my gold should be safe, yes or no? Gold value is appreciating, but not giving you any returns. Do one thing, the gold which is not useful to you and has so many drawbacks and is always keeping you in tension, why don't you give that gold to the government? Government will take all the tension. So today, bring the gold which you are not using, which you have just kept in your cupboard as your investment. Yes or no? So if you want to keep something in your cupboard, instead of keeping gold, keep a piece of paper, no? And that piece of paper is nothing but gold deposit bond, gold deposit certificate, which we are going to give you against the gold which you are going to deposit to us. Understanding? And that gold which you will deposit, the value of that gold equal to that value, a bond will be issued. Now your gold is getting converted into paper form. That's it. Now keep that paper in your cupboard. As good as gold only, but on paper. The value of gold will go up. The value of that paper will also go up. After 5 years, 10 years, the value of gold will be this much. The value of this paper will also be same. Understanding? After some years, the bonds will be matured. At that time, you are going to get the money from the government. Gold monetization scheme. Gold deposit scheme, and after certain time, under this scheme, whatever deposit bonds or certificates are issued, the certificates or bonds will be taken back from you, and against that, whatever value is at that time of the gold, that value will be given to you, resulting into huge gains. And those gains we are not going to charge, because we don't consider these items as your capital asset. If you buy them, you sell them, yes or no, if they are matured, at any time, any gain arising on these bonds or these certificates will not be taxable at all. Why? Because we don't consider these items as your capital asset. So if you have gold, keep the gold. And after some time, right now, for example, you acquired gold 5 years back, and the value of that gold at that time was 1 lakh. So at the time when the value of the gold was 1 lakh, at that time you bought that gold, yes or no? Now, today the value of the gold is, that same gold, today the value is approximately 1,60,000. How much? Understand, today the value of that same gold is 1,60,000. Give that gold to us and take the bonds worth 1,60,000. So whatever will be the value of your gold right now, no, equivalent to that value, the gold bond or gold deposit bond or gold deposit certificate will be issued. So now, right now in your cupboard, how much worth of gold was there? 1,60,000. So give that 1,60,000 worth of gold to us and take the bond, take the certificate worth 1,60,000. So your gold is converted into paper form. After some time, when the value of the gold will keep on increasing, so the value of this bond will also be keep on increasing. After some time, the gold will become 2,10,000. At that time, the value of this bond will also be 2,10,000. At that time, bring this bond, bring this certificate to us and take the money, 2,10,000. Or you can sell it whenever you want. This is as good as gold only. Understanding? So this way, what the government has done, government has brought the gold out of the cupboards of the people, and now that gold is deposited with the government. Government does not have to return this gold back. Government will return what? Money. Now this gold which the government is having, which you have deposited, what the government will do? Government will bring all these gold in the mints, and this gold will be melted, will be converted into coins, bars, then it will be converted into biscuits, and again this gold will be circulated in the economy. No need to buy new gold from outside India. And you will not be asked also that from which income you have bought this gold from. So it is a golden opportunity for the black marketeers who have converted their huge amount of black money into gold to convert their black money into white. Because we are not going to ask only that from where you have bought this gold from. To buy this gold, from where the money has come. Huge amounts of gold have been deposited with the government under these schemes. And especially all those black marketeers who used to earn black money, cash, and the cash they converted into gold. So they were holding so much amount of the gold. And majority of the gold which we used to import, no, are held by these black marketeers, will come out of the pocket of black marketeers, because they will deposit this gold under the scheme and they will take the certificate. This way their black money will be converted into white. But that is not the target of the government. Target of the government is to reduce imports, because that is the bigger issue than catching these black marketeers. And now since they have deposited this much gold, no, now they are in the eyes of government also. Now the government will keep an eye on these persons who have deposited huge amounts of gold and taken what? Gold deposit bonds or gold deposit certificates. Now right now you are safe, and right now you have also converted your black money into white money. Now you are in the radar of the government. Now sooner or later, the government can catch you in any of the things, because you are not going to improve yourself, no? Once a black marketeer, always a black marketeer. So one opportunity you got to convert your black into white. Now you are safe. This time you are safe. But now if you will do any such activity, no, the government has kept you on radar. Now you will be gone. Understanding? So first of all, the gold deposit, bonds and gold deposit certificates issued under Gold Deposit Scheme 99 or issued under Gold Monetization Scheme 2015. Both these bonds and certificates are not treated as capital asset, and any interest, what did I say? Any interest on such on such bonds or certificates will also be fully exempt under section 10 subsection 15. Understanding? So if you sell these bonds or if you sell these certificates, will you calculate capital gain? No, because they are not treated as capital asset. Yes or no? What if you hold them till maturity and at maturity higher amount is coming, because of that the gain is happening? That gain will also not be taxable. Why? Because the asset itself is not treated as a capital asset. Understanding? And why they are not treated as capital asset? Because the government has an intention to reduce the imports of gold. And to do that, these type of bonds were issued. And if the benefit is not given to the assessees for these type of bonds, the assessees are not going to take the benefit of these bonds. So ultimately, the intention will not be fulfilled. Understanding? So hence, this was your point number 5. So first point, tell me first point. The assets which are not treated as capital asset. Number 1, stock in trade. Other than shares and securities held by FIS. Number 2, movable personal effects other than PJ Das and other than residential house property, because that is not a movable asset. Yes or no? Next one, rural agricultural land. Next one, gold bonds, old gold bonds. New gold bonds are known as sovereign gold bonds. They are your capital asset also. Yes or no? Next one, gold deposit bonds, gold deposit certificates. Remember, old gold deposit bonds, new gold deposit certificates. Old gold deposit bonds and new gold deposit certificates. Both of them are not treated as your capital asset. And last asset is special bearer bonds. Which bonds are? Special bearer bonds. So if the assessee is having special bearer bonds which were issued in 1999, so these special bearer bonds are also not treated as capital asset. So 6 assets, the name you must remember. If you see any of these 6 assets, please don't consider these assets as your capital assets. Any asset other than this 6, yes or no? Any assets other than these 6 assets will be treated as your capital asset. Will be treated as your capital asset. Yes or no? But if you find any of these 6 assets, then they are not treated as your capital asset. No capital gain needs to be calculated for these assets. Understanding? Last asset is? Last asset is? They are also not treated as your capital asset. And any interest on special bearer bonds will also be fully exempt under section 10 subsection 15. Yes or no? Sure, will you remember? So now tell me, I am writing old gold bonds. Old gold bonds, meaning 6.5% gold bonds issued in 1977, 7% gold bonds, 6.5%. Then 7% gold bonds which were issued in 1980, yes or no? Then there are national defense gold bonds. They were also issued in 1980. Then new gold bonds. Then new gold bonds, also known as sovereign gold bonds, SGBs. Yes or no? Then gold deposit bonds and gold deposit certificates, GDBs and GDCs. Okay, no? So gold deposit bonds and gold deposit certificates, GDBs and GDCs. Now first of all tell me, if you have any of these assets, okay, First of all, you are supposed to tell me, are these assets treated as your capital asset or not a capital asset? Yes or no? First thing. Then you are going to tell me that interest on these bonds will be exempt or will be taxable. Sure, sir? So first of all, tell me, capital asset, not a capital asset. Any old gold bonds, not a capital asset. And the interest is also E for exempt. Under section 10 subsection 15. New gold bonds is a capital asset. And interest is also T for taxable. Gold deposit bonds, not a capital asset. Gold deposit certificates, not a capital asset. And the interest on the gold deposit bonds and certificates is also exempt. Special bearer bonds. Special bearer bonds. Capital asset, not a capital asset, not a capital asset. Any interest on them is also fully exempt. But remember, at the time of sovereign gold bonds, there is one important point, that transfer by an individual on maturity is equal to exempt transfer. Under section 47, at that time the capital gain should not be calculated. Otherwise, on sovereign gold bonds, the capital gain will arise. Will you remember? Sure, no? Okay, perfect. So this was the definition of your capital asset. The term capital asset includes A, B, C, and it does not include A, B, C, D, E, F. Okay. Now your focus should be on which assets? The assets which are not capital asset or assets which are capital assets. So see, you have many assets or properties. Out of these assets or properties, there are certain assets which are covered under the what? Exceptions A to F. Yes or no? Those assets are capital asset or not a capital asset? Not a capital asset. So no point of calculating any capital gain. No capital gain needs to be calculated. Now all other assets or properties, can I say they are your capital asset also? And on their transfer, the capital gain will also be calculated. Now if they are your capital asset, now you are supposed to classify your capital asset into two parts. So first you will have to find out that is it my capital asset? If the answer is yes, this is your capital asset. Now on the transfer of this capital asset, you are supposed to calculate the capital gain. Now to calculate that capital gain and to know that what is the nature of that gain, okay, you first know the type of the capital asset, which can be short-term capital asset or which can be long-term capital asset. You are going to classify any asset like this or only capital assets like this? Assets which are not covered in the definition of capital asset, ignore, na? But all the other assets which are your capital assets, yes or no? On their transfer, you are going to calculate what? Capital gain, yes or no? So now you will have to calculate the capital gain. Capital gain can be short-term capital gain. Capital gain can be long-term capital gain. But how will you come to know the nature of the gain? The nature of the gain depends on the type of capital asset. If you want to call the gain as a short-term gain, then the gain will be short-term gain only if it is on the transfer of a short-term capital asset. If you want to call your gain long-term gain, then the gain will be long-term gain only if it is arising on transfer of a capital asset which is a long-term capital asset. Sir, but why would I call my gain as a long-term gain or a short-term gain? You don't have to call it. Government wants you to call it your long-term gain or a short-term gain. Because on long-term gain, the rate of tax is different. and on short-term gain, the rate of tax is different. Now, if you want to correctly pay the tax to the government at correct rate, you have to pay tax at this rate. If the gain is a long-term gain, the rate is different. Or if the gain is a short-term gain, you have to pay this much tax to the government, tax at this rate. So what rate of tax should be applied on your gain depends on the nature of your gain. And nature of your gain will depend on the type of your asset. Because any gain arising on transfer of short-term asset will be known as short-term gain. Any gain arising on transfer of long-term asset is known as long-term gain. Now, till the time you will not know the nature of your gain, you will not know that how much tax you are supposed to pay. You might end up paying more tax or less tax. That is not correct. So till the time you don't know the nature of the gain, you will not be able to know the rate of the tax which you are supposed to pay. And to do that, you must know the nature of your gain, and nature of your gain depends on the type of your capital asset. Hence, you are classifying your asset into two parts: short-term capital asset and long-term capital asset. One more reason is there. See, it is not necessary that always the gain will arise. Sometimes the loss might also arise. So, there are different rules for set-off of long-term losses and short-term losses. Long-term capital loss can be set off only against long-term capital gain. It cannot be set off against short-term capital gain. However, the short-term capital loss can be set off against short-term capital gain also, and it can be set off against long-term capital gain also. Now, you calculated your gain, you calculated your loss. Instead of gain, the loss can also be coming, no? Now, you don't know the nature only of the loss, that what type of loss it is. Long-term loss or short-term loss. Will you be able to do the correct set off of those losses? No, because you don't know the nature of the loss only. So the correct nature of loss will allow you to do the set off also correctly. For that, you should know the nature of the loss, and the nature of the loss depends on type of capital asset which is transferred. Understanding? Hello? So how many types of capital assets are there? One is short term, another is, now what is a long term capital asset? What is a long term capital asset is given in 229A. And what is a short term capital asset is given in 242A. Now what is a long term capital asset? Any capital asset which is not a short-term capital asset is a long-term capital asset. No, really, this is the definition. The capital asset which is not a short-term capital asset is a. So first you try to make your asset short-term. If your asset does not become short-term, definitely it is a long-term. So now what is a short-term capital asset? Don't say no. Short-term capital asset, define. Now if your asset falls in this definition, it is short-term. And if the capital asset does not fall in this definition, then it is long-term. Understanding? So now pay attention. Short-term capital asset 242A. Any capital asset whose period of holding, what did I say? Period of holding is up to 36 months. I am telling you the old provision first. Old provision. Okay, no? Then I'll tell you the new provision which is applicable for you. So whatever I am writing right now is just for the sake of making you understand few things which are required in the subsequent discussions. So first I am telling you the old provision, what was there. And last year, here some amendment has already come. So this is not what you are going to follow. What you are going to follow, I am going to tell you. But first, What was the situation 1 year back? Last year? No. Last year. Last to last year. What was the situation till 2023-24? The situation was any capital asset whose period of holding is up to 36 months. Up to that capital asset is short term. Meaning that if the holding period of that asset is not up to 36 months, then it is not a short-term capital asset. It is a long-term capital asset. Meaning that, hello. Capital asset held for 36 months or less, then it is short-term. But what if it is held for more than 36 months? Then it is not a short-term. And the asset which does not become short-term becomes long-term. So holding period more than 36 months, long-term. Holding period 36 months or less, short-term. Now, there were 4 assets. How many assets? I'll write the names. Okay, 4 assets. Listed securities, then units of equity-oriented mutual fund, units of UTI, and last but not the least, zero coupon bonds. Okay, 1, 2, 3 and 4. In the case of these 4 assets, their period of holding should be less than or equal to 12 months. How many months? So even if their period of holding is less than or equal to 36 months, still they can be treated as long term. Because for them, you are not going to check 36 months, you are going to check 12 months. So if their period of holding is 12 months or less, only then they will be treated as short term. But what if their period of holding is more than 12 months? Then even if their period of holding is 36 months or less, still they will be treated as long term. For all assets you are supposed to see 36 months. But for these assets you are supposed to see 12 months. So any asset will be a long-term, short-term asset if its period of holding is 36 months or less. So for these assets, even if their period of holding is 36 months or less, still they will be treated as long-term. If their period of holding is more than 12 months, they will be treated as short-term capital asset only if their period of holding is 12 months or less for these 4 assets. Yes or no? So forget about everything. All assets 36 months. These 4 assets 12 months. So if their holding period is 12 or less, they are short term. More than 12, they are not short term, they are long term. 2 more assets. How many assets? 2 more assets. I am writing 2 assets. 2 assets. One asset is unlisted. Unlisted shares. Guys, what word I have used here? Securities. And what word I am using here? Both are same or both are different? The securities will include everything. Shares, bonds, debentures, everything. Yes or no? But they must be listed. So listed shares, listed bonds, listed debentures will all be covered in 12 months. But what about unlisted shares? It will be covered here. So for unlisted shares, you are supposed to check how many months? 24 months. So if their period of holding is less than or equal to 24 months. If their period of holding is less than or equal to, then they are what? Short term. And one more asset, immovable property. Which property? So any immobile property is there. Immobile property will also be treated as. Immobile property means what? Land, building, land and building, any type of land, any type of building. Yes or no? That immobile property will also be treated as your short-term capital asset if the period of holding is 24 months or less. How much? How much? So 2 assets. Unlisted shares. Did I write unlisted securities over here or only the shares? What about the unlisted bonds, unlisted debentures? unlisted bonds and debentures are not covered here. Only unlisted shares are covered. So unlisted bonds and debentures will cover here. No. This is about listed. So we used to check 36 months for them. Understanding or not? Any asset which is not covered in these 4 assets or not covered in these, for all the assets you used to check 36 months. For these 4 assets, 12 months. For these 2 assets, now see how much confusion. Some assets you will check 12 months. Some assets you will check 24 months. Remaining all assets you will check 36 months. Yes or no? Some assets becomes long term soon. Some assets becomes long term very late. You have to hold them for 36 months. Then they will become long term. Some assets will become long term even after you hold them for 24 months or more than 24 months. Yes or no? Some assets will become immediately long term if you hold them more than 12 months. So there was a lot of, this thing, confusion. So last year, what did I say? Last year, 23rd July, an amendment came here. And that has changed this entire thing. Now the assets for which the period of holding is 36 months. For those all assets, the period of holding is reduced from 36 to 24 months. Done. For all the assets, what did I say? For all the assets for which you used to see 36 months, the 36 months period of holding will no more be applicable for any assets. For those assets, the period of holding will now be taken as 24 months. Now, the 36 months which you used to see, are you going to see 36 months for any assets? So, with effect from which date? 23rd July 2024. Last year amendment came on this day. And why this date is very important for you? You'll understand. This date is going to come again and again in front of you in this chapter. Last year, no, election took place, 2024. Election was there, last to last year, yes or no? So in the year of election, what happens? 2 budgets come. One prior to election, second after the election is conducted and the new government has formed. So the first budget which comes before the election, that is known as interim budget. That is known as interim budget. Finance bill number 1. And that budget is, that finance bill is passed, that becomes Finance Act number 1. Number 1. This is the first Finance Act of that year. In every year, no, only one Finance Act will come. Only one finance bill is there every year. But in the election year, 2 finance bill, 2 times the budget is, budget is delivered. First, before the election, and second, after the election. So in the year 2024, first budget came in February 2024. That was Finance Bill number 1, which came in February 24. Yes or no? And that, because of that, Finance Act number 1 of 2024 was made. And just after the election, the same government was coming in the power, but still, for this tenure of 5 years, this is a new government, no? So a new budget will be coming just after the election results. So elections results was, I guess, in the month of July only. And immediately after few days, this budget was there. Second budget in 2024. And that second budget, when came in 2024, that was Finance Bill number 2 of 2024. And that gave you second Finance Act in that year. Finance Act number 2 of 2024. And in that Finance Act, heavy changes were brought in capital gains chapter. So the first change which came was, Mrs. Nirmala Sitharaman said that there are different period of holdings prescribed under the existing law for different types of assets, because of which assessees get confusion that what period of holding I should check for which asset. And some assets are becoming long term very soon, and some assets are becoming very late. So there is a disparity here also. We want to bring everything on same platform and remove the confusion also. So from today itself, in the budget speech only, budget speech was happening on 23rd July, and immediately with effect from today itself, if any asset is transferred for which the period of holding used to be checked as 36 months, if that asset is transferred on or after 23rd July at any time, yes or no? Now on or after 23rd July 2024, whenever these assets will be transferred, for these assets, the period of holding 36 months used to be checked. Now that period of holding will be 24 months only. So the period of holding of 36 months is done away. Now for all the assets we are going to check 24 months, for which the period of holding prescribed was 36 months. But no change in these four assets. Meaning these four assets on or after 23rd July also, before 23rd July 24 also 12 months, on or after 23rd July 24 also 12 months. These two assets, no change. Prior to 23rd July 24, 24 months, on or after 23rd July 2024, 24 months. But the assets for which you used to check how many months? 36 months, like jewelry, paintings. Understanding or not? Unlisted unlisted of debt-oriented funds, this and that, for all those assets. Earlier it was 36 months. Now for those assets for which you used to check 36 months, if those assets are transferred on or after 23rd July 24 at any time, if the assets are transferred on or after 23rd July 2024, and for these assets, earlier you used to check 36 months, from now onwards you are going to check 24 months. Now for all assets, the period of holding is 24 months. So if you transfer your asset in 25, 26, are you transferring on or after 23rd July only? Yes or no? On or after 23rd July 24, meaning in this year if you are transferring on or after 23rd July 24. So for all the assets you are going to take how much period of holding? You are going to check how much period of holding? 24 months. But if you would have transferred that asset prior to 23rd July 24 then you would have checked 36 months. So if the transfers were taking place prior to 23rd July, if the transfers took place prior to 23rd July, 36 months, 12 months, 24 months. These three types of period of holding you used to check. Now 12 remains 12, 24 remains 24, but that 36 will now become 24. So if the assets are transferred at any time on or after 23rd July 2024, for these assets, instead of 36 months, now you are going to check 24 months. Will you remember? What are you going to check? Holding period. Holding period of holding or holding period. So holding period of the asset means what? The period for which the asset was held by the assessee prior to its transfer is nothing but holding period, no? So when the assessee will start holding the asset, the date on which he has acquired, from that date he will start holding. His holding period will start. Until what date he will be holding? The date of transfer. No, immediately prior to that. Immediately prior to that. Meaning from the date of transfer, somebody else will start holding it. I am holding only till the date immediately preceding to date of transfer. For example, I am transferring one asset today. So am I holding that asset till today? No. I am holding till My holding period is before the date of transfer, because from today you are going to hold it. Your holding period will start from today. So the date which is considered as your date of acquisition in your holding period cannot be taken as the day in my period of holding. Getting my point? So from today, as on the date of transfer, you start holding it. So my holding period is immediately before that. It will end. So for example, I have purchased one asset. I have acquired one asset on 19th of November 2011. So when did I acquire that asset? 19th of November 2011. So this is the date on which I have acquired the asset. From this date, my holding period will start. And it will end on date of transfer or immediately prior to that. So what if my date of transfer was 6th of December 2025? So the date of transfer is 6th December 2025. From this date, somebody else will start holding it. Yes or no? The transferee to whom I am transferring the asset, that person will start holding from 6th December. So I was holding immediately prior to date of transfer till that time only. Yes or no? So my holding period will end on 5th of December 2021. So from the date of acquisition till the date immediately preceding to date of transfer, this is the period of holding. This period of holding for 4 assets, 12 months or less, the asset is short term. More than 12 months, the asset is long term. For 2 assets, 24 months or less, asset is short term. More than 24 months, long term. For all other assets, I used to check 36 months ago, earlier. Yes or no? So now I am going to check 24 months. For all the assets, this period of holding is given. So now tell me, what is the period of holding? What is the period of holding? It is the period which will start from date on which the assessee has acquired the asset for the first time. So the capital asset became your property for the first time. From that date, the period of holding will start. It will end on the date immediately preceding to date of transfer. That is your period of holding. This period of holding for 4 assets, you have to check 12 months. For 2 assets, 24 months. For all other assets, 36 months. But the transfer was made prior to 23rd July 24. That time you used to do that. But what if the transfer is made on or after 23rd July 2024? Then for 4 assets, it is still 12 months. For 2 assets, it is still 24 months. But for all the assets for which it was 36 months, now it is 24 months. Will you remember this? Name of 4 assets. Listed securities. Units of equity oriented mutual funds. Units of UTI. And last one, zero coupon bonds. Number 1, listed securities. Listed. Number 2, units. Units of any mutual fund? No. Only equity oriented mutual fund. Any units of UTI. Units of UTI can be any units of UTI. UTI means Unit Trust of India. Last one, zero coupon bonds. For these 4 assets, how much period of holding you will check? Okay, no? 2 assets. Unlisted shares. Number 2, immovable property. For these 2 assets, 24 months. For all the other assets, you used to check 36 months if the transfer was made prior to 23rd July 24. But if the question tells you that the transfer is made on or after 23rd July 2024, you are going to check 24 months now instead of 36 months. Will you remember? Sure. Take a small break. After the break, we are meeting and we'll continue from here. Half an hour, huh? Not half an hour, take 40 minutes. Take 40 minutes.